Hello, traders. Hello, good people. This is Waveman, and we are back for another session of Beginner Forex Series. And this one in particular, is a very, very crucial and important topic. Okay, this one is so important that you need not miss any second of this. Yeah, and the topic we are looking at today is risk management in forex trading. Okay. This topic is very important in a way that regardless of what you do in forex trading, if you don't manage your risks, you're wasting your time. Okay? You need to be so good at this and consistent with it to go far. There are so many good traders out there who haven't made it, who are still struggling just because of this risk management. And I'll tell you, in forex trading, problems don't come at you one at a time. They come from all angles. I'll tell you, risk management combined with greed, fear, you're dead. You're dead before you even begin. So what is this risk management? It's simply protecting your capital from big losses. Okay, it's managing what you risk in a trade or in trades. And what is the goal? Stay in the game long enough for your strategy to work. Okay, you will deposit your money, you'll get that funded account. Your first 2-3 trades are losses. Okay, but what guarantees you that on the fourth trade, on the third trade, your account is not blown, you've not breached your maximum drawdown? It's risk management. Okay, if you're good at it, you never know the fifth, sixth trade will be the winning trade. Okay, it will be the winning trade. And why is risk management greater than strategy? Here is why. Let me tell you, the truth is, even good setups lose money. I've been on trades whereby I'm 3/4 way to take into profit, just a quarter the move to hit take profit, but the market crashes down and sometimes hits my stop loss when I don't move my stop loss to break even. Because sometimes I execute trades and then I get busy in that day. They just keep running and I don't move the stop loss to break even. You come back when the stop loss has been hit, and that is just another day in the life of a trader. Okay, trust me, good setups lose money. They do. So uncertainty is a constant. Let me tell you, for each trade you take, even if you're 80% sure that this setup is going to hold, there is that 20% that this trade could go against you. So uncertainty is constant. Risk is your defense. So in that 20% uncertainty, or the case whereby the trade is going to go against you, how do you plan on tackling that? You risk. You manage your risks. Don't over risk. There is always, even if it's a 90% chance the trade will go to your direction, there is always that 10%. Even if it's 99% chance, I don't know how you would achieve that, but there is always the 1%. Okay? And the truth is, most traders fail due to poor money management. And where does this problem come from? It comes from the way most of you perceive forex trading. People actually think it's a quick money scheme. I'll tell you, they have lied to you. Forex trading is not a quick money scheme. It's not. I'll tell you the truth. I myself, I have moved on from telling people to join forex trading. No, I don't influence people to join forex trading. I help the ones that have decided to take the path of forex trading. I help them. They are the ones I help. But the ones who are innocently living their lives, I keep them away from forex trading, because you need a strong mind and a soul of a fighter to trade forex. It's not for people who are weak. Okay? Then we have types of risk in forex. Okay? Risks in forex. We have account risk, trade risk, market risk, psychological risk. So account risk is the total capital exposure. Okay? What do we mean by that? How much, what's the money you're putting into this trading? If you decide to deposit $1,000, that is the amount you're risking on forex trading as an investment. If it's $5,000, that is the amount of money you're risking in forex trading as an investment. That is the account risk. Then the trade risk. This is the risk you take to make money. Let's say I'm willing to risk $20 to make $100. That is a trade risk. Okay? Then market risk. This is volatility, slippage. Take a look at news hours. That is market risk. You're innocent. You're a retail trader behind your phone, behind your laptop, but Powell is cooking something for you at around 3 p.m. East African time. He's there cooking. You don't even know. For those of you that don't know where to check for news from, smiling at your 10 pips profit trade, the money is coming with a 50 pips counter trend news that is about to blow your mind. To make it worse, you don't even have a stop loss. You're just there taking screenshots. That is market risk. These are risks attached to the market. Then psychological risk. These are emotions. Revenge trading. Okay? You enter a trade, put your 20 pips stop loss, it's hit. On gold, for example, you enter another one. Okay, let me put 30 pips stop, it's hit. Then you're like, you know what? To recover the 50 pips I've lost, I'm now going to enter with 5 times the lot size. I close in 5 seconds. You enter, the thing jumps 10 pips in the opposite direction. Then you start asking, why does God hate me? Trust me, your problems are too small for God to even focus it on you. So, how do you do risk per trade calculation? Okay. Now, so risk, of course, equals to account times the percentage you want to risk. Okay. So, normally they advise traders to risk 1 to 2% of your capital. But let me tell you why this is hard. Most people will deposit $10 on their account, 10 US dollars. Then you tell someone like this to risk 1 to 2%. By the time 10% of $10 is $1, someone is going to risk 1%, $0.1. Like, that's like, I don't know, the value of 1 pip. You get? So most times, if you're trading a small account size, you can't even know. You just enter trades, because you'll be like, after all, it's only $10. And that is a very big mistake you make, not attaching value to small money. Let me tell you, do you know if you saved the $10 10 times, you have $100? Which, by the way, now 1% or 2% is now $2 or $1. And then if you saved the $10 100 times, you have $1,000 to trade, whose 1% risk is now $10. Okay, so let's look at this. If you have a $1,000 account and you're risking 2%, of course you're risking $20. So stop loss is 50 pips. If pip value equals to 1, then you use the lot 0.4. Okay, that's the lot size you use. So these are the golden risk management rules. Never risk more than 1 to 2% per trade. Always, by the way, always use a stop loss. Okay, always and always use a stop loss. These things are full margin. Let me tell you, it's fun until it's not. Until it's not. The best approach to forex trading is establishing consistency. If you have this $100, you go full margin, you make 600. Then the next 4 streaks you're losing. Let me tell you, you might say, I've made $600, I lost 400, I still have 200 profits. I'll tell you, the truth is that psychologically it will deal you a very huge blow. You'll even doubt if you're a good trader. But if you're consistent, if you're losing small monies, if you have a risk of 2%, for example, if you lose one trade, if you take trades of risk to reward of 1 to 4, for example, 1 to 4, if you lose $20, you're losing $20 to make $80. So if you lose 4 times consistently and then you win once, you recover your losses. That is the beauty about risk management, risk to reward, and all this in forex trading. Let no one lie to you that risk management won't take you anywhere. The habits you build on those small accounts will help you thrive when you get the big accounts. Because one day you will have money, $10,000 you put it on your account, and you can't trade it because you are used to your $50 and then you go full margin. Now you have 10k. You're even scared to put lot 100 and start your full margin things. But the habit you build now on the small accounts will help you. Okay, let me tell you, the same people that tell you no risks, no Ferrari. No risk, no Ferrari. Let me give you an example. First of all, with your $50 account, you shouldn't be singing no risk, no Ferrari. You'd be lying to yourself. Someone that has a $100,000 account, if they risk 20% of that money, 2% of that money on 100k, they're risking $2,000, right? 2%. They're risking $2,000. If their risk to reward is 1 to 4, so 2 times 4, they're making $8,000. 8 bob. Now, if this person traded for 1 month, those are 30 days. They have about $240,000. Let's just have this theoretical thing of they went 30 days with wins. They have about $240,000, and trust me, they will buy a very good sports car. Now, you with your $50 account, I don't know how you'd have to trade that account to get that Ferrari in that short period of time. Okay? So, there are people who are good at this game. I'll tell you, there are people who are good. I've seen people flip $100 to 10k, to over 10k. But as a beginner, that shouldn't be your direction. Focus on being humble, mastering these skills, so that forex trading doesn't frustrate you like it has frustrated so many people that have left it. So, point number 3, know pip value before placing a trade. Of course, study the currency pair you're trading. Study it. Don't just enter. Gold doesn't behave the same way as your USD. Then risk to reward ratio must be favorable. So if you're taking a trade, don't take trades of risk of 1 to 1. You're risking $20 to make $20. That is not a good trade. At least 1 to 2. Risk 20 to make 40. And then you can also do the good ones, even 1 to 10. I've also taken so many setups that are actually even more than 1 to 10. I've ever taken a trade of 1 to close to 40. 1 to 40 actually. Yeah. So it's all about knowing the game. Never over leverage or trade with fear. Okay? Let me tell you, when you build a habit, it becomes it becomes easy. Even if you lose, you're like, oh, let's just wait for the next trade. It won't frustrate you. It won't. So, risk to reward ratio. So let's say you're risking 20 pips and then the reward is 60 pips. The risk to reward is 1 to 3. Okay? That one is easy. That one is easy. And you know what's funny with this? Let's say you have a risk reward of 1 to 3 and then you've taken 10 trades. Yeah? 10 trades in these. Now, in these 10 trades, you have risked about, what is 10 times 20? 200 pips, right? You've risked about 200 pips in trades. And now, if you win 3 out of those, remember, wins equals to 60 pips. So if you just win 3, what is 3 times 60? 3 times 60 is 120 plus 60 is 180. 180 pips profits. And then you have what? What is 7 times 20? 7 times 20 is 140. It's simple. So you see, you will have 140 losses. So let's say you are risking, you entered with size of 0.01. So 140, you've lost $14. But 180, you've made $18. You're in profits. You've only won 3 trades, by the way, out of 10. But you're not in drawdown. You're in profits. This is because of risk management and being consistent. And trust me, this is what consistency is. It's not blues every day. It's not. And if you're able to achieve this, you're good. You're good. So, how pros think about risk? Focus on long-term results, not the short one. Accept losses. Keep risk consistent. Then control risks. Don't avoid it. Don't avoid to execute trades. Just control the risk. Okay? That is what you need to do. Control the risk. Don't avoid it. So, drawdown and recovery. So, let's say you've entered drawdown of 10%. You'll need 11% to recover. If you entered 25%, you'll need 33%. If you entered 50%, you'll need 100%. If you entered 90%, you'll need 900% recovery. So please, protect your equity. Protect it at all costs. At all costs. And then, smart risk management tips. Use a risk calculator. So I have a risk calculator. If you need it, just drop a comment and I'll get to you. Comment risk calculator, I'll give it to you. And then track trades with a journal. Scale risk with growth. Okay, what do they mean by scale risk with growth? If you've successfully grown your account twice its size, instead of now trading 0.01, you can go to 0.02. Just make sure it's between the 1 to 2%. That's it. You're good. Think like an investor, not a gambler. Yes, by the way, this is the game changer. If you think of forex trading like an investor and not a gambler, things will change for you. So, example of a conservative setup. If you have a $500 account and then you risk 1%, which is of course $5, if your stop loss is 25 pips and the pip value is 0.1 and you execute a trade using a lot of 0.2, okay, and your risk reward is 1 to 3, your win will equal to $15 and your loss equals to just $5. You're losing $5 and you're winning 15. Okay, that is an example of a conservative setup. So common mistakes in risk management, we have doubling up after a loss. You have one loss, the next time you double the lot size. Then removing stop loss, okay, which is very bad. Risking 20 to 50% on one trade. Trust me, your account will go. Then ignoring compounding. Yeah, you know what compounding is? it's like, let's say if you trade, you just withdraw your profits. You trade, you withdraw your profits. There you're ignoring compounding. With compounding is let the account grow, let the account grow, let the account grow. You compound profits. Okay? Then trading on emotions. Trust me, that will mess you up the most when it comes to risk management. By the way, never put your rent, your tuition on forex trading. Never do that. Never trade off such money that you're going to make something out of it and then refund it. Don't, because emotions will really affect you. Yeah, so trade to survive first, you will thrive second. Okay? Trade to survive first, thrive second. Wins and losses will come. Risk management just keeps you in the game, guys. Thank you. So join our channel on Telegram at Wayman Trades, and I'll be seeing you guys on the next one. Have a great day and God bless you all.